Is one of the benefits, that you mentioned briefly, and I want you to elaborate on that. You made the point about, HNIs still finding this attractive. And if you look at our Indian capital markets, maybe it's the world over, but at least one can talk of India, that uh, it's always been the corporates, the HNIs who enter first. So even when we, had online trading, it was them who really came in. DMAT happened, it was them who came in first, and then the retail followed. If you are saying that even post 31st March, HNIs, corporate treasuries are still seeing value in debt funds, then do you feel it's a matter of time that retail will also see the value? And I think it's more of an education issue, isn't it? I mean, vis-a-vis equity, where a lot of education has happened, much lesser has happened on the debt fund side. For an individual to understand that how can I get these good yields, how does the interest rate cycle affect my returns, which probably a corporate or an HNI, because they have a team of people, they do understand this. But the point you made about capital gains, the fact that in an FD, I get that interest accrued to me every year, and I pay tax on it if I'm in the tax bracket. Whereas here in a mutual fund, if I hold it for 10, 15, 20 years, I'm only going to pay the tax at the time of redeeming. I mean, is that a benefit? I mean, what are your teams who are going out and trying to convince retail investors? What are they telling them? Why should you still be in a debt mutual fund?
So there are multiple questions in your question. One, let me clarify that after from April, mutual fund debt schemes have seen only inflows and substantial inflows. So it's not that there has been any outflows because of lack of the tax benefits. I don't remember the numbers, but I think close to about 1 lakh crores would have come in at least in the mutual fund industry in fixed income markets. Secondly, yes, you made a good point that initial drivers of any change is typically the corporate world, which can analyze things better and faster, and the HNI community, which is perhaps guided by the wealth managers and their own analytical teams. So, debt has always been a part of the allocation of the individual investor without them knowing it. So, for example, when you put money in insurance companies, you are indirectly putting money in debt. When you are putting a bank FD is nothing but debt. The only thing you don't know is because you are not holding the paper in your hand and you are not seeing the fluctuation in the underlying prices on a daily basis. So you're not really aware of it.
Mm.
In this case, since you have a daily mark to market, you have a return, you are able to see the way things are moving. Now, we had done a small analysis about 3, 4 months back when we saw that the returns on, let's say, a CRISIL bond index had come to about 8.75% in the last 15 years. So it is not that returns have not come. They have been choppy because the interest rate environment has been choppy globally. We have seen 2, 3 crises, and sometimes the inflation surges. And the more the intervention of the central bank, the more volatile the interest rates get. Now, this is something which the retail investor cannot wrap his head around, and which is why mutual funds or the distributors have not really spent too much time trying to explain that, because the greater distributor the distributor earns a greater amount in pushing fixed equity products. The debt part is taken care by other products, which are not mutual funds, and sometimes by direct bonds as well.
Mm.
Now, I think going forward, when you see that there are no upfront commissions to be paid to distributors, the TERs are coming down, there's only trail fees, and people will realize that to bring in stability in the portfolio value, you require a component of debt. I think mutual fund distributors will soon start, advocating fixed income products as well.
Hmm.
So it's a combination of various factors, which I think initially they might look not so great, but I think eventually it will lead to a more widely dispersed and allocated, well allocated portfolios, which do well in most circumstances. Because typically the benefit of debt is that when the economy does badly, debt performs because central banks tend to keep monetary conditions light and they ease the monetary conditions. And typically at that time, equity markets might not be doing well because the outlook on economic growth is not good. So it's a very good hedge for the from a portfolio perspective, that when your equity is not doing, your debt is performing. When your debt is just giving you the coupon rates or slightly lower than that, then your equity is performing.
Hmm.
So one has to find an optimal balance between debt and equity allocation. Currently, as a country, we are all return chasers. We try to chase the highest returns, and equity markets have been performing very well and have served the purpose of returns well for mutual fund investors. And which is why the focus on debt has been low. But I think going forward, there will be better sense, and people will try to sell both the products.
Hmm. Hmm.
And of course, you give another extremely good example that you pay tax only when you redeem from the mutual funds, while in FDs you accrue the coupon or the interest rate on a daily basis, and you have to pay tax periodically every year.
Hmm.
So that itself is a good advantage. You can push your tax liability to a much longer period, and that could also lead to a longer duration of holding from mutual fund investors.
Hmm.
So yes, there are benefits. There are definitely diversification benefits, hedging benefits, possibility of higher returns, possibility of tax being paid later. So in fact, you have highlighted some of the very good lessons of the debt mutual funds.